Here's how my daughters bought their first business, and here's how you can too. They came to me to buy a brick and mortar business. The business cost $150,000. Clearly, my 12 and 14-year-old didn't have $150,000. So I structured loan documents that both my daughters signed that they owed their dad $150,000. And as a nice dad, I didn't charge them interest. Their 2 locations after year 1 made over $250,000. So luckily for them, they were able to pay dad back $150,000 of that $225,000, leaving $75,000 to go into their operating account. So if you're not my 12 and 14-year-old daughter and you have a cash flow business, you can come to someone like myself or anyone else similar to me, and you can proposition to borrow $150,000 against that company's cash flow, because there is a demonstrated cash flow coming in. And I'm only speaking for myself, but I do those types of deals all the time.
Okay, the math doesn't work there. If the business costs $150,000, generally businesses sell for a multiple of their cash flow. But let's say in this case, it only was a one-time multiple and really the business made $150,000. They were willing to sell it for $150,000. And the business in the first year made $225,000. I guess if he's saying made, maybe he means profit. So they were able to pay him back. But generally, in order to grow a business, you have to invest. So some of the money they would have potentially paid him back was presumably invested in growing the business. So this doesn't make a ton of sense. It also only works because a 12-year-old and a 14-year-old have all their living costs covered, right? If you go buy that business and you have to run it full time, you've got to pay yourself something. You've got household bills, money you need to live on, so you wouldn't be able to pay the loan back in a year anyway and live on nothing for a year. And just the whole idea that a 12-year-old and a 14-year-old are running a full-time business and making $250,000, don't they go to school? Like what's I don't know. This doesn't make a lot of sense. Typically, when you buy a business, a lot of the deals that we see that we've helped with, people are using an SBA loan to buy the business to fund the acquisition cost. And those are 10-year loans. So you have 10 years to pay back the money used to buy a business. And by having the loan stretched over 10 years, that's the only thing that keeps those payments low enough that you can afford to pay the loan and pay yourself and hopefully have a little left over to grow the business and return your own investment in the business. So to expect to buy a business and pay the loan back in a year, it's highly, highly unlikely and highly unusual that that business would be selling for a low enough price but make enough money that you could pay it all back in a year unless you grew it like 5x the first year you had it. So it's a nice story, but it just doesn't make a lot of sense. And I wouldn't go around thinking you're going to find somebody willing to cut you a check for $150,000 unless he's your dad and is also going to pay for all your living costs for that year. So it seems unlikely.
Learn from selling it for multiple 6 figures. But to actually sell a business, it is very much ideal that you have all of your income and expenses recorded on some sort of ledger. Having your financials recorded on paper is a foolproof way of getting your business valuated. If you're taking cash in your business and you're not recording it, then you can't actually prove it. Second is that people are willing to pay more for your business the less you work in it. The third thing I learned is just to focus on actually building the business itself. People will actually come to you and notice what you're doing.
First, yes, as a business owner, you should be keeping good books. And that's whether you're planning to sell or not. If you are taking cash in your business and not recording it, you can do that. But when you go to sell, you're not going to get credit for that cash. So my suggestion is, if that's how you run your business, a year before you decide you're ready to sell, stop doing that and start putting all that cash in the business to make it look better, to get credit for that cash that you otherwise were taking home and not counting. She's correct. You don't get credit for it when you sell, but having it on the books is going to allow you to get credit for it and get a better price for your business, much more than the amount of tax that you're going to pay on that cash that you're now disclosing. But having it on paper, no. Have it on a good digital accounting system like QuickBooks or Xero if that's what you use. Do it correctly, or make sure it gets done correctly every month, on time, accurately. Then when you go to sell your business, you'll be in great shape to prove to a buyer what the business is actually worth. She's also correct in that people will pay more for businesses that can be run absentee or semi-absentee versus businesses that require the owner's entire full time. People would rather buy a business that'll spit off cash without them having to work in it than where they have to quit their job to go run this new business that they've acquired, which they might not have the skill or the interest to do. It just shrinks your buyer pool when you have to be actively involved full-time in the business. So building up to the point where you're only part-time or mostly absentee is also a great thing to do. And then her third point, she didn't know she could sell her business, but then what she was doing was preparing to sell the business. So I'm a little confused about that. Finding a strategic buyer generally will get you the highest price versus finding a general buyer who's just looking to buy a business and has no connection to that industry or nothing to synergistically add that business to. Sounds like she found somebody who was a good fit for the business. They came to her and they increased their offer until it made sense for her to say okay to a multiple six-figure offer. I just say what it was and multiple six figures. But anyway, so I think she's got some good points. If you're thinking about selling, be strategic about it, be long-term thinking about it, have good books and records, work your way out of the business to get a higher price, and then find the best strategic buyer to sell it to get the highest price. If you do all that, you can have a very nice exit. If you have questions on that or need help on that, happy to chat.
Would I go in there and get a loan or raise money for investors? I think if I was doing my first project, I might prove it with going in there and getting a loan. Although for most people it's super uncomfortable going into the banks, like going to court and being interrogated. I would always go to investors because you can go on, do numbers and numbers and numbers of projects. There's so much money out there available for you to get access to.
Okay, so the advantage of a loan is they don't own you. When you pay the loan back, you're done and 100% of the business is yours. So if you're gonna borrow money, you just need to make sure that the business is viable and that you're gonna be able to pay it back. If you're not sure, then don't borrow it. With investors, if you take money from them, they're generally gonna want some profit share, some payback, but they're also gonna want to own a part of the business. And now you're connected to these people indefinitely, even if long after you've made way more money than they put into it, and you're still, again, you're the one doing all the work. So my suggestion is make sure you understand why you're using the money or what you're getting the money for and how it's going to be used. If you want to do something risky that you're not sure it's going to work, well, with investor money, you don't have to worry about paying it back if it doesn't work. So there's that advantage. But if it does work out well, now you've got partners forever. So it's, again, not a one or the other. One's better, one's worse, or always do one, don't never do the other. It just depends on the circumstances and what you see for the long-term outcome of the business and what you're willing to take on as far as risk. With the bank, when you borrow, you're going to have to pay it back whether the business works out or not. With investors, if it doesn't work out, you don't have to pay it back. But if it does work out, you've got partners you may not want for longer than you want them.
My mentor just bought a business and my mind is blown with his return on investment. This restaurant had been in business for over 20 years. The seller was ready to retire and he didn't even realize that he could sell his business and was about to close the doors. My mentor started evaluating the numbers and realized that they weren't necessarily clean because the CPA made some mistakes on the tax return, and that presented a huge opportunity. They agreed on a purchase price of $600,000. My mentor went through the SBA to get a loan, put 10% down, just over $60,000 after closing costs. In his first month in business, he did $30,000 in net profit. That means he'll make his money back in just over 2 months. The restaurant has really strong management in place, and his first year, he's going to bring in probably over $300,000. There are opportunities to be had out there, people. Business owners are retiring and want you to buy their business.
Okay, interesting. First, I keep saying mentor, my mentor. That somehow rubs me the wrong way. It's great that she has somebody helping her out, but my mentor sounds a little weird. But that has nothing to do with anything. So I find it interesting that somebody who was going to just close the doors, didn't know his business was even worth anything, was suddenly able to come up with a $600,000 price to sell it. Because if you decide something's worth $600,000, but the day before you were willing to just close the doors and walk away, I don't know, something seems a little off about that. But let's assume, okay, that is correct. The business is worth $600,000. Yes, you can definitely get an SBA loan with 10% down. If you've seen any of my, Would I Buy This Business segments, I talk about that a lot, how you can finance and get into these businesses. So $600,000 selling price, $60,000 down. You do need some money for working capital to make payroll and to buy food and everything first off. But let's just say, $60,000 down gets you into it. The first month, they had $30,000 of profit. You didn't get to take all that home because he had to make the payment on his SBA loan. So it's going to take more than 2 months to really make his money back. But yes, if you're looking at your investment as just your down payment, which is fair, and the rest of that loan is going to be paid by the business, then if you can find a good business to buy and you can swing the down payment and you can take that business and run with it and grow it and do well, it can absolutely be a good way to get into entrepreneurship, build your personal financial standing, and down the road, sell that business if you want, move into something else, buy something else. I think it is a valid lesson. I think there are people there who have viable businesses that aren't thinking about selling them or don't know how much they're worth, and you can potentially get a good deal. She mentioned that part of the reason they got that price was the CPA made some mistakes on the tax return. Again, that doesn't really hold together. If there were mistakes made, that doesn't change what the value is. You just figure out what the business is really worth and buy it for that, not count on CPA tax return mistakes. But at the end of the day, the idea is valid. If you can find a good business, buy it with a loan, use the cash flow of the business to pay the loan back, you're not going to get the whole $30,000 of profit, but you're still going to do well. Just make sure the business you buy is one that you can grow and run successfully, and you're not buying something that somebody else was just trying to get out of a problem from, because a lot of businesses for sale, it's really just somebody with a big problem hoping to unload it on the next sucker who takes it over for them and gets them out of it, and now it becomes their problem. So you don't want to be that sucker. You want to know what you're buying and buy smart.